The conversation all morning for the rest of the show is Georgia Congressman and member of the House Budget, Energy and Commerce Committees, Buddy Carter, back with us. Also with us is Stephanie Pomboy, Kevin O'Leary, John Lonsky, and, of course, Cheryl Casone. John Lonsky, let me come to you and get your thoughts on these numbers here, your reaction to the PCE, Employment Index, and income and spending.
Oh, pretty much in line with expectations. That year-over-year increase for the core PCE was a little bit less than what had been anticipated, 4.1%. One surprise would be that meager 0.3% monthly increase by personal income. And also we had a lower than expected growth rate for the employment cost index. Right now, it seems as though perhaps wage pressures are easing. The problem, however, is that we still have a tight labor market. We don't have much room to grow, to add jobs without having to face renewed upward pressure on wage growth. That worries me going ahead, especially with, the stickiness of service sector inflation. Service sector inflation will ultimately depend on what happens to wage growth. If that were to pick up because of growth on top of a tight labor market, then we will find that it'll be all the more difficult to get rid of rapid inflation, and we'll have a longer than expected stay by a elevated federal funds rate.
Yeah, I want to get Cheryl's take in a minute on services inflation versus goods, because this was the issue that Robert Kaplan just brought up with us. The former president of the Dallas Federal Reserve said this just a few moments ago. Here it is.
The economy is very much a mixed bag. The goods sector is weak. Anything interest sensitive is weak. Small, mid-sized businesses who are very dependent on the Fed funds rate are having a harder time getting a loan. While that's going on, the service sector has been pretty resilient and the consumer has been strong. And so this has been a bit of a puzzle for economists to figure out. I think the X factor that explains it is government spending. And I mean the remaining American Rescue Act money that has not been spent at the state and local level, the Inflation Reduction Act that's stimulating hundreds of billions of projects around the country, the Infrastructure Act, all those acts are stimulating demand for goods, services, and workers. And what I'm seeing around the country is that's making the service sector resilient, helping the consumer. It's keeping the unemployment rate low. My guess is without this government spending on the fiscal side, we would have a much weaker economy than the one we have now.
On that note, let me bring in Representative Buddy Carter. Congressman, you just heard what the former Fed president said about all that spending. That's what's keeping the economy growing here. I'm wondering how you see it, given the fact that the Fed is the only one apparently trying to take down inflation, with Joe Biden's administration still pushing stimulus.
Well, and this is unsustainable. When the government spends more, you have less. We all understand that. And look, we're all glad that inflation's going down, but it's still so much higher than it was when this president and this administration took over. That's what we have to keep in mind. And people are still hurting. In the district, when I'm in the district, people, Bidenomics in the state of Georgia is a 4-letter word, and it's not a good word at all.
Cheryl Casone, do you have any new info on this month's data in terms of services inflation versus goods inflation?
I do, because if you go, it's the services inflation is that's where you really see the employment cost bump up that Stephanie Pomboy was talking about ahead of the data that we just got, because that year-over-year employment cost index is up 4.5%. Because businesses are having to hire more, because people are spending more on services, that's where you're seeing that bump up. We're seeing that in wages and salaries. The month-to-month gain was 1% for in the second quarter for wages and salaries. Benefit costs 0.9% higher. That's that tight labor market we talk about. So the services sector, even though that's where you're seeing people spending, and that's where you had that little bit of a boost in consumption, a little bit better than expected at 0.5% versus the estimate for 0.4%. It's obviously that companies, small, and I'm going to say small businesses, because that's really who's getting hit here. Let's be honest here. Those are the ones that are having to spend more, and we are seeing all of those numbers in a positive light right now. All of those reads were to the upside, Maria.
All right. Kevin O'Leary, your reaction.
If you're invested in the S&P 500, this is great news because it supports the, basically a soft landing. And so the index will continue to perform. But that only represents 40% of employment in America. The other 60% is on small business. And there is no good news in these numbers for small business. What it tells you is there's still a probability, probably around 30%, that the Fed will raise another 25 basis points in September. That puts out current account loans to small business somewhere between 10 and 14% from a AAA credit. So that's going to be really difficult. And in the factoring market, it's already up 80%. So if you want to factor your Walmart receivables to small business, you're going to pay 17 to 23% right now. And that's why I walk up and down the Hill in the last couple of weeks talking to every senator or governor that I can, or congressman or woman. You've got to start looking at the other 60%. These acts, the IRA and the CHIPS Act, this is great for you if you're an S&P 500 company. There's nothing for the small guy, zero in there supporting small business. And this is where the cracks are going to hit. This data tells you there's trouble in paradise for small business, where 60% of our jobs are created, and no one gives a beep about it.
But Kevin, you're over here day after day telling us that the small regional banks should go away. I mean, isn't it true that those small businesses are relying on those small regionals?
So we have to do two things to help them out right now. And this is an idea that Hagerty had that hasn't gone anywhere yet. You're correct. You heard Kaplan earlier saying there's going to be a consolidation, no question about it. We got 4,600 regionals. I tell you, within 5 years, there'll be 2,000 left. During this transition period, which is so important for small business, let's do two things, and that's what I'm pounding the Hill for. Number one, in a current account, that's an account where you pay payroll on Wednesday nights, where you make no interest on your money. Let's guarantee those accounts for the next 24 months by the government, just this account, for up to $100 million, so small businesses can make payroll and don't fear pulling their capital out of small banks. That's a support mechanism just for 24 months. In addition, and I'm not the only voice crying out for this, let's extend the Employee Retention Credit Program for another 24 months during the same period to let those small businesses tap their payroll that they were offered back in 2020 and 2021 in a credit that keeps them alive. There is no bill anywhere supporting small business. The only one active right now is the Employee Retention Credit. There were hearings on it yesterday, and there's a lot of people concerned about fraud in it, but there's a way to clean that up and extend the program for 24 months. Nobody cares about small business, Maria. Nobody. And somebody's got to pick up that handle. I walk around with a sandwich board on down the halls of Congress saying, small business.
Buddy Carter, your thoughts?
Well, I certainly care about small business, having run a small business for 32 years in my professional career. And there are many of us who care about small businesses. But he's absolutely right. Everything that's being done is aimed at the Fortune 500 companies. And this is not sustainable. That's what people don't understand. We cannot continue to pump money, government money, back into the economy. This is, the more money the government spends, the less you have. And people are really hurting here. 49% of all people have said that they're worse off this year than they were a year ago.
Yeah. And Stephanie Pomboy, it's those very businesses that may be under pressure from rates as they keep moving higher.
Absolutely. I mean, it's so refreshing to hear this conversation about all the companies outside the S&P 500 because, you know, I'm an economic nerd. So when I look at corporate profits, I prefer to look at the government accounting of profits, which covers every company in the country and tends to tell a different story from what's going on with the top 500 companies, which now is just the top, whatever, 7 or 11 companies that are really dominating the index. And the reality is that when you look at these broader numbers as produced by the BEA, you get a much bleaker picture of what's going on. In fact, you know, I mentioned earlier how interest expense for the S&P 500 is up 71% year on year. It's declining across the country on average. Now, why would interest expense be going down after the fastest, most aggressive rate hikes in history? Because of that enormous swath of bankruptcies we've seen. They're not paying interest because they're out of business. So this is the bifurcation we're seeing right now. Things are so bad in the non-S&P 500 universe that those are the companies that are going bust, that can't service debt at higher rates, that can't support keeping their enterprise going and their employees, et cetera. So this is a problem, and I'm really glad to hear people focusing on it, because we look so myopically at the S&P 500 as if it's the be-all, end-all, but it really doesn't reflect the economy more broadly. And that's particularly important at turning points like we are right now.
Well, look at the consumer strength. Personal spending up 0.5%, while income was up 0.3%. What's holding the consumer up like this?
Well, two things. I actually scribbled down. The two important questions when you see consumer spending numbers are, one, what are they buying? Are they buying stuff because they need to or because they want to? And number two, how are they financing those expenditures? And on both counts, what we're seeing is not good. As I mentioned earlier, 48% of the growth in consumer spending this year has come from housing and healthcare. That's not a sign that they're feeling great and exuberant and want to go out and spend. And they're financing this by drawing down saving and running up credit card debt. The other thing I would note here, which is kind of interesting around this whole conversation about goods and services, is that in this number that we just got, a few minutes ago, you actually see a slowdown, a slower rate of growth in services than you do in goods, which is, a turn. It's a difference. And actually in the 2Q GDP data that we got yesterday, spending on restaurants and leisure was down, which is also stunning. So maybe we're starting to see the consumer say, all right, we're done. We've tapped out. We took our vacation, but now we've really got to rein things in. I don't know. It's too early to tell, but I thought that was interesting.
It is. I'm surprised, actually. John Lonsky, how would you assess these numbers?
Well, I want to point out that this 0.3% monthly rise by personal income is misleading. If you look closely at the components of personal income, what you find out is that wage and salary income, employment income, that rose by 0.6%. The only reason why you got the slowdown in personal income is because of reductions in dividend income, according to the federal government, as well as a reduction in transfer payments. We're still seeing pretty rapid growth by employment income. That's telling me that this upward pressure on wages might just persist, and this becomes a major headache for the Federal Reserve later this year and next year. The latest reading had the average wage up. It was 4.4% year on year. But when I look at these latest wage agreements and these strikes and whatnot, I'm under the impression that wages are growing by something between, say, 5 and 7% year over year, a much faster rate. And that might well be true, given how tight the labor market is and given how much government spending we have taking place now and in the pipeline because of the CHIPS Act and also because of IRA.
Great point there. Let me get your take, Kevin, in terms of where this market goes. I mean, look, we're talking about a rally that very few expected this year. The Nasdaq up 34% year to date. S&P 500 up better than 15%. What are your thoughts in terms of allocating capital now going into year end and next year?
If you look at the classic mix that was, pre-pandemic, for most money managers, it was 50% equities, 50% fixed income. And that was put under tremendous pressure when we brought interest rates below 3%. And most managers moved to a 70-30 model, I included. That was the standard. Today, when we have these narratives about where we're going to go for the next 4 quarters, because you can't really see past that, plus you really don't want to be in the wrong side of an election outcome you can't predict yet. So we're now staying at 70% equities, 30% fixed income. But I must admit, Maria, every day when we look at offers that are shown to our desk, I'm seeing some very interesting opportunities in corporate credits, AA, single A credits, paying up to 9%. You know, that's never been around for a long, long, long time. So I anticipate some pressure on how much more upside we can get on equities because, frankly, this morning I bought some corporate paper. I didn't buy any equities. I'm pretty happy making 9.2% for 36 months. That's not so bad. And I think that's really what's going to happen. So I would be a little bit more concerned about how much more juice we can squeeze out of the equity lemon right now.
Yeah. Cheryl, what do you want to say about goods inflation versus services?
Well, I like to always look, whether it's CPI or PPI or this report, I like to look at the year-over-year, components, because I feel like that's just such a much better context than the month-to-month data, which is important. But if you look at prices for goods year-over-year, down 0.6%, but services inflation is up 4.9% year-over-year. What I think is interesting here is, remember, we heard from Jerome Powell this week, and he told reporters, he said, look, we're basically on track to do another quarter-point hike in September if the data warrants. And I think that that's where this, shift in this inflation data might actually change some of the bets that we're going to have for another rate hike. And that's been, great for banks, great for savers, but certainly, not good for a lot of large corporations and even small corporations, if you will. So I think that's interesting. Look, we're sitting, some of these inflation numbers, that preferred inflation gains at a 39-year high. It's 5.4%. It was sitting at a 5.4% in April of 2022. So the inflation story is better. Again, I think it's how the Fed reads this. But it certainly is a market positive. If this data, and then we got the jobs report next week, if that kind of, has the Fed kind of back off a little bit, that would be helpful.
Yeah, great point on the jobs numbers. We'll be covering that. Buddy Carter, I want to get your take on year-end business because you all are about to take your recess for the next month plus, for the August recess. But government funding is going to expire on September 30th. None of the 12 appropriation bills that are funding the separate agencies are finished. What are the priorities when you come back in September? And there's a fair question about a government shutdown. Earlier, we heard from one of your colleagues who said to expect a continuing resolution.
Well, first of all, no one wants to shut down, whether you're an independent or a Republican or a Democrat. A shutdown is just not good. We all understand that. We want to avoid that. We did adjourn yesterday. We will be out for the month of August, as we traditionally are. We'll come back. We'll have 3 weeks in September. We got a lot to get done. Now, yesterday, we were able to get the Milcon bill passed out of the House. It's still got to go to the Senate. We got a lot to do there. A lot of work, a lot of heavy lifting, as you indicated, to be done. Will they be a short-term CR? Perhaps. No one wants to see that. Certainly, we've committed not to do an omnibus, so let's make sure that's off the table. But at the same time, we've got to get these appropriation bills done. And this is a heavy lift. This is very difficult to get them done, but we've got to do it.
So in terms of holding back money in the appropriations process, Congressman, given the FBI and the stories around a two-tier system of justice, what are your thoughts in terms of where some of those appropriations bills goes when you're talking about things like the FBI or the IRS?
Well, first of all, let's make sure we understand the role of Congress. We control the purse strings. That's the way we get these agencies' attention. And certainly we want to get the attention of the DOJ, of the FBI, that we feel has been weaponized and being used against, frankly, against conservatives. And we want to get their attention. So, yes, I think you can look forward to that, at least coming out of the House. Now, look, keep in mind, we got two chambers here. We got the House and the Senate under different majorities. So that's something to be considered. And a perfect example is what the Senate did yesterday when they looked at the NDAA and took out some of what I felt like and most conservatives felt like were good points that were added to the NDAA to address wokeness and abortion in the NDAA, which I feel like should have been addressed. They took it out of the Senate. Now it's going to come back to the House, and I suspect it's going to pass. But it'll pass with a different set of votes. These votes will be mainly from the Democrats and from just some Republicans.
Mm-hmm. Stephanie Pomboy, let me get your reaction to all of this and thoughts in terms of where things go now. How surprised are you by this huge rally in stocks this year? NASDAQ up 34%, S&P 500 up 18%, and we're well past the half mark.
Yeah, actually, I started to get deja vu all over again because right now it feels so much to me like spring of 2007 when we started to see these cracks in the asset-backed commercial paper market, and the stock market just continued to rally in the face of it. At that point, the parallels are really pretty incredible because we were also at the final stretch of Fed tightening, and the market was also discounting an end to that and a quick reversal. So over the span of 15 months between late 2006 and 2007, the S&P rallied 28%. Today, it has rallied 27% over the span of 10 months. So it's a very similar situation where credit market issues are being dismissed by the stock market as sort of isolated and contained and to be resolved swiftly once the Fed pivots. And I, as you know, suspect that expectation is going to be proven to be incorrect. And, I just loved Kevin's point earlier, which is one I've been trying to make for so long, about how high yields have gone up for corporate borrowers. And he's looking at it as a buying opportunity. I obviously am more cautious, but the question that he raises is one that everyone should be asking, and that is, why the hell am I buying stocks, bonds, whatever it is you're buying, when you can get 5.5% sitting in a T-bill? I mean, why not just wait and see if it's going to be different this time, or if we're going to have a real credit bust? I mean, you're getting paid to wait and sit on the sidelines. So, the corporates he's talking about are too rich for my blood. But, I'm very happy to sit in cash and gold and just observe for a little while. So that's where I am.
Yeah, Maria, you think about it. The poor savers in this country, they've had 20 bad years. They deserve a 5.5% rate right now.
Yeah, great point. Yeah, and banks are still not budging very much on deposit rates, even as the Federal Reserve raised rates 11 times. Kevin, when you look at this rate story, I mean, look, you've been talking about higher rates potentially killing certain banks because they can't afford these higher rates, and yet the market is trading up. How surprised are you? The fact that if things were so bad in banking, why do we have an S&P 500 up 18% year to date?
Well, I think you just look at the numbers, Maria, and say to yourself, okay, we tested this thesis that some percentage of managers of 4,600 banks in their life have never dealt with rate hikes like this. Remember, these are, in many cases, junior management. And so in the case of Silicon Valley Bank and First Republic and Signature, everybody blamed that on idiot management. So I ask a very simple question. What percentage of the 4,600 banks right now also have idiot management? Is it 15%, 20? I don't mean idiot. Yeah, I guess I do. Idiot management. And so how do we know when they're going to fail? We don't. So the market's building in a factor of consolidation with 100% certainty. It's in the market now. The question is, what do we do about it? This narrative about small business we had this morning is not on the tips of anybody's lips in Congress. But you're going to get it soon. It's going to start happening in the next 90 days when all of a sudden their constituents, after the recess is over, put up their hands and say, listen, I've got some huge problems here. I can't finance anything anymore. And I think that's when all of a sudden we'll be back on this panel talking about what fixes for the other 60% of the economy. We've got the S&P covered. There's so much cash for them, they have no problems for the next 3 years. The small guy is screwed.
Maybe, but look, expectations are rising across the board on the macro story, on the markets. John Lonsky, can you talk about that a bit, how expectations have changed across Wall Street?
Well, you're right. I mean, we have on Wall Street, we think S&P 500, I don't, but the market thinks S&P 500 revenues are going to accelerate. Profits are going to go from no growth this year to nearly 13% growth next year. However, these views collide with what Jerome Powell recently stated. And what he was saying was that we're not going to be finished with Fed rate hikes until the labor market cools by enough so that we have a material increase in unemployment that prevents wages from rising faster. Better yet, wages will grow more slowly. It's almost as though they're living in two different universes, because if Jerome Powell is correct that the economy slows, you're not going to have 13% earnings growth next year. And that's perhaps a reality that the equity market has yet to face.
Yeah, Stephanie, are estimates still too high in terms of earnings?
Absolutely. I mean, I couldn't agree with John more. And as I mentioned earlier, we're looking at, and he's at 12 to 13% for next year, which is sort of just immaculate growth, because you wonder where that's going to come from when you see the wage numbers. And again, oil going back up. And at a time when the consumer appears to be really starting to reach exhaustion. And to that end, I would underscore, while everyone's going to look at today's number and say, no, the consumer's not near exhaustion. Again, look at what they're buying, not the total amount they're spending. But then also, we're running up toward the end of this student loan suspension, which ends at the end of August in theory. And so we'll see what kind of impact that has. I suspect that will have an impact of some magnitude that will not be good. But, in general, I agree 100% that the market is dismissing what is reality on the ground. When you look at the economic data, there's so many indicators that we are already in recession, whether it be the yield curve, leading indicators, real retail sales, go on and on. And yet the market seems to believe that that's a good thing, because the Fed's going to pivot. And right now, it doesn't look like we're getting a Fed pivot, and it doesn't look like the economy is going to swiftly rebound. So, reality is going to be a rude awakening when it comes.
We're about 30 minutes away from the opening bell. I want to quickly take a look at the price of oil. You mentioned it earlier, Stephanie. Oil above $80 a barrel. That, of course, the underlying issue with regard to inflation. We'll check that right before we send it over to Varney and Company. Thanks, everybody. Great conversation. Have a good weekend, and we will see you soon. Opening